You know, the internet is saying all these myths about how the stock market makes money for you. And I think you've got it a little wrong. So in this video, all these 4 myths, I'm gonna debunk them in 10 minutes. The first myth. Everyone says invest in a SIP and you will make money. Not entirely. See, if you invest in, say, Nifty for one day, the chances of you seeing a loss is about 46%. But if I change this time frame from one day to, say, 10 years, it's actually 0%. So it's very clear that the longer you actually invest, you'll actually make money. Now, I know you already know this, but there's a point to what I'm going to say. Over here, we can see that BSE Sensex over a 1-year SIP duration gives a 22.7% negative return. But over a 10-year, it's 0%. But now, look at something else. Something you didn't know. On the right side, you'll see small cap. Even over a 5-year period, there is a 17% chance that you will actually lose money. But on the Sensex or Nifty, it's actually much, almost close to 0. Let's look at this 5-year period again, but this time look at mid-cap. In BSE Sensex, it's 0.5% that you will see a negative return, but for mid-cap, it is almost 5%. My point is, all equity is not the same. And the reason why this happens is that stock markets are lumpy. But actually, it gives a spiky return over a short period, and then we sort of average it out. Which is why we never say returns. We actually say CAGR, returns over a period of time. But let's say you invest for 5 years. But let's say you invest for 5 years. But let's say you invest for 5 years. Actually, I said that 3 times because no one is investing for 5 years. Only 19% of direct SIPs continue up to 5 years. Everyone else is buying iPhones. So this makes actually no sense. People aren't behaving correctly because they think money should come as a timetable. But another thing that doesn't happen in a timetable is you not subscribing. We get all these views, but most of people aren't. So can you just pause? Hit that subscribe button because there is a lot more things about investing we would love to teach you. And if we don't come in your feed, this won't help. So please hit that subscribe button. Another cool thing they talked about is returns. So let's imagine 2 scenarios. Market goes from 100 rupees to 150 rupees. And it's a 50% return. Now, in both cases, let's say someone is doing a SIP. But the way that we get to this 50% up is different. In scenario 1, the market goes up a little bit, goes sideways, goes down a little bit, and then in a single year, goes all the way to 50%. Okay? Over a 5-year total period. The second scenario is the market falls and immediately goes up as a V-shaped reversal. But in both cases, the market got a 50% return in the end. The SIP returns will be different. You know why? In a V-shaped reversal, imagine every point you adding a SIP and the market returning and going up very quickly. You did not have enough time to accumulate. But in a scenario where the market was flat, didn't do much, and then suddenly goes up 50%, you had accumulated so much of SIP in smaller, cheaper units that this V-shaped return meant that you made more money. So when the market is sideways and down and not doing much, it's actually good for an SIP investor. Now here's a quiz. Imagine that you've invested in the markets for 8 years, or let's say 9 years, and then the market falls or crashes. What will be your return even after the crash? I know what you're thinking, that 8 years is a long time. So the returns must be good, right? Choose between any of these 3 answers. None of them are right. You would actually, if COVID was the crash, despite investing SIP for 8-9 years, your return would have been 1.9% and 3.5%. That means even after investing all your hard-earned money for 7-8 years, you would have still seen almost a break even on your portfolio. What? But here's the good news. After 2026 March, if you would have looked back again, you would have seen that your CAGR would have become 13.5% in both scenarios. So the point is, even if you're investing long term and you forget about it, this volatility exists. Myth number 2, living off dividend income. I'm sure you would have seen this on the internet where someone says that if you have a portfolio, dividend income comes and it becomes another income. True, partly. So let's look at what a dividend yield is. So your total invested amount, uska kitna percentage, kitna amount will become your dividend income. The yield, let's assume, is a very healthy 1%. This is very high, by the way. It could be much, much lower. But let's assume it's a 1% dividend yield on your entire portfolio. That means if you invested 1 crore rupees, you will earn 1 lakh income a year. Imagine the guy who's invested 1 crore rupees, uske liye 1 lakh a year is kitna? That's almost what, 8,000 rupees per month. It's certainly not a lot. And this scales as it goes. Let's suppose your portfolio is 10 crore rupees. So your yearly dividend income, before tax by the way, is 10 lakh rupees. What is that? It's 80,000 a month. For the guy who's invested 10 crores, 80,000 a month may not be that much, that too pre-tax. The number becomes really significant if you have 20, 30 crores. But if you have that much, then why do you really care about dividends? So please stop optimizing for dividend income. Another hack is that people say that once I have a large corpus, I'll start withdrawing a little bit and that can become my income. That is actually not an SIP, that's called an SWP, and we've made a video about it. You should go check it out to understand how that actually works. And the next myth is silver. I'm talking about silver because everyone was talking about silver because it did this crazy rally. And there's another thing. When you open any app to invest in a mutual fund, you get top funds. Look at this chart over here. It's very simple. Look at the top row, you will see 1. 1 basically means the best performing mutual fund of that year. And these funds are from a group of the top 30 funds. You'll notice in 2009-10, the best performing fund the next year was 38th best performing. Just because a fund has performed a certain way this year has no connection to what it will do next year. Everyone who's investing in an asset because it performed really well this year is victim to this thing called recency bias. So, silver, like I was saying, is exactly the same. Because silver performed really well, everyone invested in silver. Now, it's quite likely that silver will underperform this year. So, here's the first thing you should explore. Rebalancing. Basically, imagine you have 100 rupees, 80 rupees is in equity, and 20 rupees is in some other instrument. Let's suppose some kind of debt. But equity doubles and this 80 becomes 160 and you're left with just 30 rupees in bonds, which hasn't moved much. Now the allocation is not 80%, 20% anymore, and you're not okay with that allocation. So you reallocate or you rebalance. And that way, when something grows way too much, you have a way to actually balance your entire portfolio. So you're not risking too much in one asset, which is the entire point of investing. The second is goal bucketing. Honestly, this is a little philosophical because when you do this, thoda crisis aa jayega. The question is, when you hit a certain money target, what will you really do with it? Now, to make my life easier, I'll tell you what I did. I removed car and house from these goals because it's very easy to finish your goals with just these two things. If you remove these two things, you have to think really hard. What do you really want? And you're thinking in very long time frames, right? 10-year, 20-year time frames. So how do you actually write all those goals down? Then tag them. Short term, ultra short term. Maybe you want something in 3 months. Maybe you want something over 10 years. Tag all those goals. And once you do that, try to correlate with your portfolio, no matter how small or large it is. Even if your SIP right now is modest, please write down your goals, tag them, and then figure out kaun si cheez kahan par hai. So you don't want to invest in equity for a 3-month goal. Makes no sense. So if you have a short-term goal, look towards debt. If you have a long-term goal, look towards equity. Again, if you want us to do a dedicated video on this, let me know. We're releasing an episode every single week, so please hit that subscribe button right now so you don't miss any episode. The third thing is very scary, but I want you to do it. Promise me you'll do it, okay? You have to write down max risk. Okay? Max risk is where you're saying, yeah, thoda worst case scenarios I'll put in bullet points. See, we've already done the goals you want to hit, right? So we feel good about it. Imagine you lost your job today. How many months of money can you actually survive on? If someone gets ill and that person, loved one, is in the hospital for 30 days, find out what is the plan right now for the cost of one night in a deluxe room or a private room in a hospital near you. Multiply it by 30 days, then double it because there'll be other costs. Do you have insurance to cover this? Likewise, go one after the other and write down all the risks. You'll suddenly see that for a lot of this, you do not have the money or the cover. And this is completely fine. This is a short-term target you have to hit. So we talk about long-term, 10 years, 12 years. What's more important than investing is making sure that these big risks, unknown risks, are taken care of. If you play the game long enough, the upside takes care of itself. Luck will hit you and then some spiky movement will happen and you'll make a lot of money, you'll do what you want. But if there's one mistake and the opposite happens, you'll never live to see that luck hit you. Because none of us prepare for risk. But we imagine and daydream greed. So can you be that top 0.1% which can actually plan for that risk? And hopefully, none of it ever happens. But at least you were prepared.